Breaking. This video is no longer a thought experiment. As of February 28, 2026, the Strait of Hormuz has become effectively impassable. Here are the real-time figures. Brent crude has surged plus 28% in a single week, reaching $92. WTI recorded a plus 35.6% jump, the largest weekly increase in futures history since 1983. Iraq has shut down 1.5 million barrels of daily production. On March 4th, Qatar Energy declared force majeure, officially freezing annual deliveries of 77 to 82 million tons of LNG. These figures have been verified by the IEA, KPLR ship tracking, and Bloomberg. In other words, as you sit in front of your screen watching this, the crisis we are discussing is unfolding live. When you make your morning coffee, fill up your car, or pay your bills, does this question ever cross your mind? Who sets these prices? Part of the answer lies in a tiny waterway, only 33 kilometers wide, squeezed between Oman and Iran, the Strait of Hormuz. Approximately 21 million barrels of crude oil and liquefied natural gas pass through here every day. This represents roughly 21% of global oil trade and 17% of LNG trade. This video explains what history tells us, what cards the Fed holds, and how you, as an investor, should read this map. Without panicking, but without closing your eyes either. If you're ready, let's begin. The anatomy of Hormuz. Why is it so critical? To understand the Strait of Hormuz, imagine a single shelf in a supermarket. This shelf carries the energy exports of Saudi Arabia, the UAE, Kuwait, Iraq, and Qatar. 90% of the total oil exports from these countries must pass through this narrow bottleneck. Alternative routes do exist. Saudi Arabia's east-west pipeline to Yanbu and the UAE's pipeline to the Fujairah terminal are the primary ones. However, the capacity of these lines is roughly 6.5 million barrels per day, only one-third of Hormuz's typical traffic. For the rest, there is no alternative. Pay special attention to the Qatar issue. This small nation, which accounts for 23% of global LNG exports, has no export route other than Hormuz. This means when the strait closes, it's not just crude oil. The natural gas that heats European homes in winter and runs industrial plants enters an immediate shortage. This isn't a theory. It's a concrete supply deficit documented in the IEA's own World Energy Outlook report. What does history tell us? Lessons from the 1973 oil embargo. Let's open the page to history's greatest energy experiment, the 1973 Arab oil embargo. In October 1973, OAPEC countries halted oil exports to the US and the West. The result? Crude prices quadrupled in 4 months, jumping from $3 to $12 a barrel. Mile-long lines formed at gas stations in the U.S., and some states implemented odd-even license plate rationing. Inflation hit 11% in the U.S. and double digits in Europe. Was the crisis permanent? No. Markets rebalanced immediately after the embargo ended. But here is the critical detail most analysts miss. In 1973, the global economy relied largely on domestic production. Globalization wasn't nearly as vast. The 2026 economy, with its intertwined supply chains, instant financing models, and energy-intensive AI infrastructure, is far more fragile to energy shocks than in 1973. The message from history is this: the crisis isn't unavoidable, but its impact is multiplied. The 1979 Iranian Revolution and the Second Shock. The "it won't happen again" fallacy. "This time is different" are the four most expensive words in history. In 1979, the Iranian Revolution and the subsequent Iran-Iraq War gave the world its second major energy shock. This time, prices flew from $13 to $34 per barrel. But the real trauma wasn't the price. It was the practical lesson in a theoretical concept: stagflation. High inflation and stagnant economic growth occurred simultaneously. Stagflation is a central banker's worst nightmare because the two tools used to fix it, lowering rates for growth or raising them for inflation, cannot be used together. Fed Chair Paul Volcker tried to solve this dilemma by raising interest rates to a historic 20%. The result? A very deep recession in 1981 to 1982. Fast forward to today. The Fed already went through the fastest rate hiking cycle in history between 2022 and 2024. Its balance sheet is still near $7.2 trillion, and the policy rate doesn't have much maneuverability to respond to geopolitical shocks. The Hormuz closure has caught the Fed in exactly this vice grip: the 1990 to 1991 Gulf War. The gap between panic and reality. I have a question for you, and be honest. What would you have done in August 1990 when Iraq invaded Kuwait? Crude oil nearly doubled that month, going from $21 to $46. While mainstream media blasted energy apocalypse headlines, the rest of the market panicked. But for the cold-blooded investor looking at the data, the picture was very different. Before the Gulf War actually began, the IEA had already activated strategic reserves. Saudi Arabia had rapidly increased production, and when coalition forces completed the operation in February 1991, oil prices returned to previous levels very quickly. Those who sold at the height of the panic suffered massive losses. Those who stayed cool-headed seized the opportunity. The lesson here: the market impact of geopolitical crises is often short-lived and largely priced in. However, that doesn't mean there is no risk. The 2026 scenario is unfolding within a much different global energy demand architecture than in 1990. The 2026 scenario. What makes it different? Why is 2026 more complex than previous crises? There are four fundamental differences, and let's talk about them with hard data. First, the state of strategic reserves. The U.S. Strategic Petroleum Reserve, SPR, dropped to about 370 million barrels after record sales in 2022, nearly half of its 2011 peak of 727 million. Total IEA member reserves can theoretically cover 90 days of consumption, but deploying them all at once is technically impossible. Second, Europe's increased LNG dependency. Following the Russia-Ukraine war, Europe decoupled from Russian gas and turned to the global LNG market. Qatar, being unable to bypass Hormuz, forces European buyers toward U.S. and Australian LNG, instantly igniting price competition. Third, the energy intensity of AI and data center infrastructure. By 2026, global data center electricity consumption is estimated to have doubled from 2022 levels. This means energy scarcity affects not just gas prices, but the operating costs of the entire digital infrastructure. Fourth, the Fed's limited room for error. Responding to a new inflation wave while the policy rate is already in the 4 to 5% range is far more dangerous and costly than in the Volcker era. This is no longer theoretical. Barclays announced Brent could reach $100. UBS said it could exceed $120 if disruptions persist. Morgan Stanley revised its 2026 Brent forecast from $62.5 to $80. These aren't panic headlines. They are the market speaking its own language. Now let's look at these four factors individually. Impacts on the U.S. economy. Is the shale revolution a shield to those saying, America is now energy independent, Hormuz doesn't affect us? Tell them to stop right there. That sentence is half truth and half dangerous illusion. Yes, the U.S. became a net oil exporter in 2018 and is the world leader with roughly 13 million barrels of daily production. But the global oil market is priced as a single entity. When a restriction in Hormuz pulls Brent oil up, U.S. WTI follows. More importantly, the U.S. still has to import heavy crude oil to supplement its own light sweet shale production. Refineries in Texas and Louisiana are designed for this heavy oil. Therefore, a price shock does not protect the U.S. consumer. Let's not leave this abstract. Gas prices per gallon in the U.S. rose 27 cents this week to reach $3.25. That's just a one-week change. According to J.P. Morgan estimates, if Hormuz doesn't open, regional production losses could approach 6 million barrels per day by next weekend, at which point pump prices will go to a very different place. According to EIA data, every $10 permanent increase in oil prices creates an additional 0.3 to 0.4 point pressure on U.S. consumer inflation. If a barrel goes to $120 or $150, you can do the math yourself. Europe's dilemma. The double energy shock. Europe's situation is much more complex. Let's use an analogy. Having cut off Russian gas, Europe has been leaning on one leg, LNG, supplied by Qatar, Norway, and the U.S. Now that the Hormuz closure has cut off a critical part of that LNG leg, what does it mean to lose both legs at once? Here is the answer in live data. Qatar Energy declared force majeure on March 4th, 2026. Deliveries of 77 to 82 million tons of annual capacity have been frozen. That same week, TTF, titled Transfer Facility, rose 35% to over 60 euros per megawatt hour. The weekly increase hit 76%. According to Goldman Sachs, this single step shrank global LNG supply by 19% in the short term. The JKM price in Asia rose 39% in the same week, meaning Europe and Asia are now in a bidding war for the same shrinking pool. Let's compare this to 2022. TTF exceeded 340 euros per megawatt hour in August 2022. The 2019 average was about 15 euros. The current crisis is a different version of 2022. But this time, the Russia and Qatar crises are happening simultaneously. Take Germany specifically. Although it significantly reduced its dependence on Russian gas in 2022, its industry's energy costs remain much higher than those of competitors in the US and China. A new energy shock would further decrease German industrial competitiveness, potentially dragging Europe's largest economy into a serious recession. France, with its nuclear-heavy energy mix, will be relatively less affected, but there is no escaping the financial market fallout and indirect effects through Germany. Europe's most urgent problem in this scenario is this. It has the money, but its alternative supply infrastructure is insufficient. The Fed's checkmate. The interest and inflation trap. To understand the Federal Reserve, you must know the fundamental dilemma of central banking. The Fed has two legal mandates: price stability, target 2% inflation, and maximum employment. An energy shock pits these two goals against each other. Here's how. When oil hits $140 a barrel, all costs, starting with transportation, food, and energy, climb rapidly. The PCE, personal consumption expenditures, the Fed's preferred inflation gauge, could push the 4 to 5% range in this scenario. On the other hand, the same energy shock severely slows growth. consumer spending retreats, corporate profits fall, and unemployment may rise. If the Fed raises rates, it chokes growth further. If it lowers them, it fuels inflation. This is exactly why the Fed has repeatedly used the phrase data dependent in its recent communications. Looking at BLS, Bureau of Labor Statistics data, core inflation, excluding energy and food, was still hovering above 3% at the end of 2024. So, when the Fed faces the Hormuz shock, it isn't starting with a clean slate, but with a half-full list of problems. The concrete lesson here: the Fed does not have the tools or the power to fight both inflation and recession at the same time. This increases the probability of a policy error. Trashing misinformation. The oil will be $200. Panic. In every major geopolitical crisis, social media and certain financial channels exaggerate numbers to grab attention during the chaos. Headlines like, "Oil to $300, the dollar is collapsing," or "Gold to double" explode during these times. This content gets clicks and shares, and the audience makes emotional decisions. Let's look at the data. The IEA seriously models a potential Hormuz restriction scenario in its official reports. In a total closure scenario, the short-term price reaction is estimated at a $20 to $50 increase per barrel. That is a serious shock, but it isn't $300. What do actual bank forecasts say? Barclays predicts Brent could reach $100. UBS says it could go over $120 if the disruption is prolonged. Morgan Stanley revised its 2026 Brent estimate from $62.5 to $80. These aren't optimistic numbers, but they aren't as pessimistic as $300 either. Why does the difference matter? Because there are absorbing mechanisms in the market. Coordinated use of strategic reserves, activation of alternative pipeline capacity, price elasticity of demand, and OPEC production decisions. Furthermore, historically, Hormuz has never been fully closed. During the Iran-Iraq War, tanker attacks occurred, but the flow continued, albeit reduced. This doesn't mean there is no risk, but drawing a realistic framework is essential so that panic doesn't destroy your investment decisions. Look to official sources, IEA, EIA, and Federal Reserve statements, not social media prophecies. That is transparent analysis. How should you position yourself as an investor? Now we come to the most important question. What should a rational individual investor do with all this information? First, let's be clear. This is not investment advice. It's a thought framework for your own research. 1. Don't overweight the energy sector at times like this, but don't ignore it either. In 2022, energy was the best performing sector in the S&P 500, up 65%. But there is no guarantee that performance will continue. 2. Always keep inflation hedging assets in mind. Tips: Treasury inflation-protected securities, commodity ETFs, and stocks focused on dividend growth have historically performed well in inflationary environments. Evaluate these assets for portfolio balancing, not out of blind panic. 3. Cash management. An energy shock can also bring short-term opportunities. If the market overreacts, assets falling below their true value can create a buying opportunity. Historically, this pattern repeated after the Gulf War, after 9/11, and after COVID. But know this: timing is not easy. An investor who misses the 10 best days in the market loses the bulk of their long-term average return. LNG Deep Dive. Who wins the Europe-Asia competition? We talked about oil. Now let's focus on LNG, because in a Hormuz scenario, this market has much more complex dynamics. Qatar alone accounts for about 23% of global LNG exports, and almost all of those exports flow through Hormuz. Major Asian buyers like China, Japan, and South Korea also rely on this LNG. So, when Hormuz closes, Europe and Asia enter direct competition for the remaining global LNG resources. Who wins this competition? The side that can pay the price. Asian buyers have historically been more willing to pay high prices in the spot market because they are more fragile in terms of energy security. Europe has tried to protect itself partially with long-term contracts, but it is still vulnerable to spot market shocks. Which side would U.S. LNG exporters prefer? Profitability, of course. If spot prices outpace long-term contracts signed with Europe, some deliveries could be diverted to Asia using legal loopholes. This isn't a theoretical risk. It happened exactly like this during the 2021 to 2022 crisis, and Europe had to pay record prices to close the gap. TTF exceeded €340 per megawatt hour in August 2022. The 2019 average was about €15. Today, the same mechanism is back in play. According to Kepler data, 13 LNG ships and approximately 1.056 million tons of LNG are currently stranded west of Hormuz. The greatest lesson of history. Panic sells. Patience wins. I have a question for you, and this time, be truly honest with yourself. If you had sold at the height of the 2008 financial crisis, when the S&P 500 was down 57%, what would you have lost? Looking back today, the answer is obvious. But in March 2009, when Lehman Brothers had collapsed and the world financial system was on the edge of an abyss, it took a very strong nervous system not to sell. Now think about this. After the 1973 oil shock, the 1979 Iranian Revolution, the 1990 Gulf War, the 2003 Iraq War, the 2008 financial crisis, and the 2020 COVID pandemic, the long-term investor always won. This historical fact doesn't mean you should ignore risks. On the contrary, understand the risks with data, not emotions. The media presents every crisis by saying, "This time is different," because that headline always gets more clicks. But historical data has proven time and again that long-term wealth building requires staying calm and staying smart during crisis periods. The Hormuz crisis has made short-term turbulence inevitable. But 10 years from now, analysts looking back at this period will likely see it as a moment that could be considered a buying opportunity. Conclusion: the value of data-driven calm. I am not thanking you for watching this video because this channel isn't doing you a favor. It's offering tools to empower you financially. The difference is important. By the end of this video, I expect you to do a few concrete things. 1. Read the IEA's oil market report and the EIA's short-term energy outlook rationally. They are free, official, and much more reliable than secondary sources. 2. Glance at every FOMC meeting minutes from the Fed. It's the best place to understand how markets are pricing things. 3. Understand the financial instruments in your portfolio that are exposed to energy risk. Which sectors are directly affected by energy costs? This knowledge will help you make better decisions during a crisis. 4. And most importantly, ask yourself, I learned this information, but what will I do today? Information is worthless unless it turns into action. Financial freedom won't come the morning you wake up. It will come to those who start building it today. No matter what happens in Hormuz, markets will exist. The question is, are you ready